every now and then I do a piece of research for 80/20 investor members where I look at value. So a lot of the time we're looking at other ways of investing, including momentum, where you're investing in things that are working. Value is a different way of investing where you're looking at investing in something because it is cheap, but then with the aim that it will revert to its long-term value, the sort of mean. So there are times where things are cheap for a reason, but there are other times where things can become cheap, whether that's an individual company share, whether it's a sector, whether it's a country, entire stock market, becomes cheap because investors fall out of love with it. And as a value investor, you might deem that actually, I think that is a good buy because you might have a view or know something that the wider market isn't appreciating yet, and then you buy into it. Then when the rest of the market catches up with you or things revert to their long-term averages, then you can make a significant amount of money. That's the aim. But of course, it doesn't always work out like that. Sometimes things go even lower. Warren Buffett is a famous value investor. So how do you apply it to your own investment portfolio? Now, there are ways that you can spend a lot of time looking at company accounts, but sometimes you just want to look at themes. You might be sitting there thinking that particular countries or sectors are unloved and they offer good value. So you might get, for example, a period of time like we've seen in recent years where maybe defensive stocks are unloved because everyone was buying technology and it was all about growth. But then defensives started to perform quite well during periods of 2022 when markets became nervous. But then technology stocks were expensive and therefore they were seemingly overpriced, and that would suggest that they could mean revert downwards. So you might want to sell out of them. There is no guaranteed way of using value. Like I say, there are things like value traps where you can get it wrong. But if you want to look at what is cheap, and you might be using it in conjunction with other strategies or ideas that you have, then you might use it as a secondary reason to perhaps buy something. Let's think of it in terms of buying things in the shops. You might have something you wanted, but then it's on sale. Then you go and buy it because you think, well, that's good value. It's a similar thing with investing. Now, what I did is I looked at value across different sectors and countries, but how can you do that? Now, one of the famous ways that value has been measured is through something called price earnings. So they'll look at the price of a share, or they could look at a wider index, and they'll look at the earnings over time. Often it's forward-looking earnings, and they might look at the earnings per share and compare that to the price, and they come up with a ratio which is called PE, so P over E, and that comes up with a number, and by using that number and tracking it over time, they can see if that ratio is higher or lower than a long-term average. Now, there is a version of this ratio called CAPE, which is the cyclically adjusted price to earnings ratio. That was actually created by Robert Shiller, who is a Nobel Prize winning economist. And what it does, it looks at the price of something versus the 10-year average earnings per share. So it really, all you've got to think about is, rather than trying to predict what the earnings would be in the future and then whether the current price was actually representing good value or not, you looked at the ability of a company. If we think about a company, their ability to produce earnings over the last 10 years, in the past, and then look at the price today and use that. And so that was deemed as one way of finding value, and it was used to predict the US stock market crash in the late 1990s successfully, which is one of the reasons it came to more prominence. And so CAPE can be calculated. It's quite complicated, but you can find the number published occasionally for different markets around the world. So looking at those markets, what I want to do today, there's a whole piece of 80/20 investor research. You can take out a free trial and look at that research. And what I did is I looked at which countries were cheap and which were expensive, which were good value based on history, so their par value. I looked at the sectors as well, because different sectors can become expensive or cheap based on history and represent value or represent them being expensive, but then looked at the funds that could take advantage of that. So that is something that's too in-depth for the podcast. So if you want to look at that, you can take out a free trial if you want to. But what I want to do on the podcast today is give people the areas where there is value, and therefore also give them some insight to say, look, if you want to take advantage of this particular country, then it is quite difficult because there aren't necessarily unit trusts that invest directly in that particular country. But if you find a fund that's got this amount of exposure to that particular country, then that is about as good as you're going to get, and that represents perhaps one way of investing in that particular area. So jumping straight across to the research. Now, I'm not going to run through all the different CAPE numbers because they're actually not important, the individual number. What's expensive and what is not is far more interesting. So strap in, I'm going to run through these at quite a quick pace. Australia is deemed as slightly expensive, as is France, India, and Spain. Switzerland, Taiwan, Turkey, and the US as stock markets are classed as expensive based on history. Areas where there's representing value are Brazil, China, Germany, Indonesia, Japan, Malaysia, Mexico, Poland, South Africa, South Korea, Sweden, Thailand, and the UK. Now, the UK has been interesting because since I've been doing this, it's always been deemed as pretty good value. So that is a market where you can find funds that invest in UK companies quite easily because obviously we are the UK. And if you look at the sectors for unit trust, there's a significant number of funds that will invest in smaller companies that based on in companies that produce good dividends, and also just growth-based companies in the UK. Other areas that I've mentioned there, so other countries, you won't necessarily find unit trust funds that invest explicitly in them. You can find ETFs that might do, but it's very niche. But you might not want to do that. You might instead just want to build a diversified portfolio and have something like unit trust funds that have just a little bit more exposure to a particular area, some of the ones of value that I've mentioned, than the average global fund. Because if you look at most global funds, what you'll find is that they are predominantly based in the US. They invest mostly in the US, and that reflects the size of the US stock market compared to other stock markets around the world. So you have to go and dig a little bit deeper if you want to find something a bit different. So looking at the funds that I identified that invest in some of these countries that are deemed quite cheap, Brazil is one where you can find funds. They do inhabit the Latin America sector, and the global emerging market funds, they tend to have exposure to Brazil. So unless you get one or two of the explicit Latin America funds, which will have something like 50 to 60% invested in Brazil. Now, if you're looking for global emerging market funds, because that's where you're going to find funds that give you some exposure to Brazil, the most you're going to get is about 10 to 13%. So if you get something like that when you're looking at a fund and doing your research, then that gives you a benchmark to know that this fund is betting on Brazil. If you want somewhere like China, of course, you've got Chinese equity funds. They've not been doing so well of late, but they do exist. There's a whole sector there. Germany, you're looking at European ex-UK funds if you want exposure to Germany. And anything over 20% is quite high. There aren't that many funds that have over 20% exposure to Germany, even though they are European funds. Typically, it's much lower than that. But if you get 20 to 30, the most I've found is 30%. If you're looking for Indonesia, then you're going to have to look at Asia Pacific ex-Japan funds. And again, you're going to get most 10% exposure to that area. So if you're looking at funds and you see something like that, you know that is a bet on Indonesia. It's above average. Even the top ones, it's mostly around about 5% you're going to get. Japan, again, there is a whole sector for Japan funds if you're after one of those. Malaysia, you're not going to find anything above 1 or 2% if you look at a diversified fund. And again, you'd have to really be looking at the Asia Pacific ex-Japan sector. Mexico is quite an interesting one because, again, if you go to the Latin America sector, you can find funds that have up to 30%. There's only actually 3 of them that have around about that, but most others, the most you're going to get exposure to Mexico is between 5 and 10%. That's quite high. Most other funds have much less than that. Poland, again, you're going to be fishing around in the European ex-UK, but also some global funds have exposure to Poland. And again, you're really only going to get 3 to 5% at best for that particular country. South Africa, then you're looking at more specialist funds or the emerging market funds, and the best you're going to get there is about 4 to 7% because it's an area that isn't heavily invested in with global funds. South Korea, you're going to see a lot more in South Korea actually, because it's a bit of a tech play. So South Korea, if you look at Asia ex-Japan funds, some specialist funds have exposure to it, and you can quite easily get 13 to 20% exposure to South Korea if you want to. So you have to go and look for that. Look on your platform. You can look at individual funds, screen them if you can on different areas. Most of you can't do that actually, or look at Morningstar. So look at some of the funds that you like for whatever reason. Look at their exposure. If it is anywhere in the ballpark that I'm talking about on this podcast, then you know it's quite focused on some of these value plays. And Sweden, that you're again looking at European UK, you can get 10% plus in Sweden, so up to 20% is the most I've seen exposure to Sweden. And Thailand, and again, you're never going to get more than 2 to 3%, and that's looking at Asia ex-Japan funds. UK, of course, you can find UK specific funds. Now, if we take the emerging markets generally, they are deemed cheap by CAPE. Europe is deemed borderline expensive, whereas global developed, which is being skewed by the US, is deemed as expensive. So if you look at all the trends that we've had out there, I'm not going to go through the individual sectors. I will mention one or two that actually it's more defensive that are now considered good value, and some of the cyclicals out there are now deemed expensive. So just to wrap this part of the podcast up, if I had to look at the trends that have happened over the last year, then generally speaking, valuations have broadly become more expensive than this time last year, with the exceptions being China and the UK, which are both cheaper. Canada is one that remained unchanged, and despite the rally you've seen in German and Japanese equities, they still represent good value. So US equities, if you're looking for somewhere that's expensive, then US equities. And just because something is expensive doesn't always mean that it mean reverts, but if you believe in CAPE as a measure and potentially a predictor of future returns, it could be a sign that potentially you're going to hamper your returns over the medium term.